Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for the 6th of February, 2023. It's great having you with me here today. And today we're going to talk about earnings and the financial markets in January. Yeah, a nice rally on long treasuries, up 6%. Yeah, was down year over year in 2022, 30%. So a little bit of movement up. Clearly a little better than the longer term, shorter term, because of the Fed and what we saw on the markets. Nice, 7% pop in the S&P, but lately we've given up a little bit of ground. Yeah, 9% is the bogey as we started the year for growth in earnings year over year. So that's a little come off, down 2% now, looking at 7, and we have seen the quarterly numbers 5. So that gives us, it was a core earnings. We're 6-1 negative guidance for the first quarter versus guidance for the positive guidance. So it tells us there's a lot of little headwind churning out there expectations. Amazon was a major contributor to that negative outlook. Still, investors are worried, right? Optimism started the year, now some pessimism. And what's happened with multiples? A lot of people talk about multiples. I'm not a bigger believer in multiples because I like to look down into the sector data and see what's going on there. But at 18 times, it's not really as cheap as people expected. What did occur in January is we continued to see smaller being beautiful. We saw the smaller, the mid and the small index doing much better than the S&P, and that's sort of continued to be a theme. I think what's engaged in that theme is what you would call a stock picker's market, which means that people really have to look down into the details in every different type of assets and companies and see what's going on in the company and how that works through the marketplace. And that's sort of, I think, a kind of a focus as we move ahead. Yes, I do think there's some prospects for the economy. I still think we are seeing the near end of the inflationary spike, and we could actually, in some goods categories, start seeing some deflationary elements. Average used car, 48, started before the pandemic, 37. So lots of room to give back, and consumers start sensing the decline in prices, that by waiting, they're going to do better. That could start cascading and be something we need to look for. I think the Fed is going to look for that, and it may kind of postpone some of this rhetoric. So as we look ahead, earnings are going to be important. A little bit of a hiccup in the fourth quarter. As we look ahead, not surprising to see companies lower expectations, lower guidance, helps their payouts if they can lower those expectations, and therefore have some better runway moving up. But still, a 7% number is not bad. And then the real wild card that sits out even beyond it is 2024. And that's actually expected to be quite dynamic and getting us back into a very strong earnings momentum. And I think when the market starts looking at 24 versus 23, I think that's going to be a catalyst moving ahead. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me.